Two people, same city, same year, both made $500,000. One paid 37% in tax, the other paid 20%. Same country, same year, same amount of money, $185,000 apart, and everything about it was completely legal. I'm Ape, and this is how it works.
Most people think income is income. You earn money, you pay tax on it. Simple, clean, fair. Except the tax code disagrees completely. There are two fundamentally different types of income, and the government taxes them at completely different rates. Type 1, earned income. This is your salary, your wages, your freelance work, anything you traded your time for. The maximum federal rate on earned income in the US, 37%. Type 2, capital gains income. This is money your money made. You bought a stock for $10, sold it for $20. That $10 profit, maximum rate, 20%. You worked for your money, 37%. Your money worked for you, 20%. That gap is not an accident. Let's make this real. Meet Sam and Alex. Same city, same year. Both made $500,000. Sam is a surgeon, $500,000 in salary. Earned income. Federal rate, 37%. Sam pays $185,000 in federal tax. Take home, $315,000. Alex manages a portfolio, $500,000 in capital gains. Long-term capital gains rate, 20%. Alex pays $100,000 in federal tax. Take home, $400,000. Same $500,000, $85,000 apart every single year. Sam saves lives. Alex watches a screen. The tax code does not care about that distinction.
But the capital gains rate is only the beginning. Here is where it gets genuinely interesting. The step up in basis. Alex buys stock for $1 million. Over 30 years, it grows to $10 million. Alex never sells. Alex dies. The children inherit $10 million in stock. The $9 million in gains that never existed for tax purposes disappear completely. The children sell for $10 million. Tax on $9 million in gains? Zero. The IRS calls this the step up in basis. Everyone else calls it passing on unlimited wealth with no tax. This is not illegal. This is the code.
One more mechanism. Carried interest. Hedge fund managers and private equity partners manage billions of other people's money. They take a fee, typically 20% of profits. That fee is taxed as capital gains, not as earned income, not as a salary. The manager who made $50 million managing your pension paid 20%. The teacher whose pension it was paid 37% on their salary. Same country, same year. The person protecting the money taxed higher than the person managing it.
Here is the part most people skip. Why does the code work like this? The official argument, capital gains tax breaks encourage investment. Lower the rate, more people invest, more businesses grow, more jobs created. There is real economic theory behind this. There is also real lobbying behind this. The financial industry spent $2.2 billion in lobbying in 2024. The result is a tax code that systematically favors those who already have assets over those still earning them. Not illegal, not hidden. Written down, in the law, available for anyone to read. Almost nobody does.
So, what does this actually mean in practice? If your income comes entirely from working, you are at the top of the tax rate structure. If your income comes from assets you already own, you are at the bottom. The system is not designed to keep you poor. It is designed to make already accumulated wealth dramatically cheaper to maintain than new wealth is to build. That asymmetry compounds over decades. It is the mathematical engine behind wealth concentration. Not greed, not corruption. The tax code, working exactly as written. Here is everything in 60 seconds. Earned income, wages, salary, freelance. Maximum rate, 37%. Capital gains income, profits from assets. Maximum rate, 20%. Step up in basis. Inherited assets reset their value at death. Gains accumulated over a lifetime disappear for tax purposes. Carried interest. Fund managers pay capital gains rates on performance fees, not earned income rates. The gap between Sam the surgeon and Alex the investor, $85,000 per year, same income every year. None of this is illegal. None of it is hidden. It is just written in a language most people never learned to read. Here is what Ape wants you to take from this. The tax code is not a neutral document. It reflects decisions about whose income the government values more. For 70 years, every major tax reform in the United States and most developed economies has maintained or widened the gap between earned and investment income. That is not an oversight. Understanding this does not tell you how to vote. It does not tell you what is fair. Ape has no opinion on what is fair. Ape only explains what is. What you do with that understanding is yours. Drop a comment below. Tell Ape, did you know earned income was taxed higher than capital gains? Most people don't. That gap in knowledge is exactly what this channel exists to close. Hit subscribe. Ape will keep explaining the financial systems that affect your money, that nobody broke down properly. See you next time.